Hello there, ExxonMobil employees. Welcome and thank you so much for spending a bit of your afternoon here with us today. I'm Sam. I moderate these presentations and we do try to keep them short so that you can get on to enjoy your afternoon, however that may be. Before we do get started though, I'd like to just quickly remind you that we are not ExxonMobil here. We're not affiliated nor endorsed by ExxonMobil, so please keep that in mind as you're listening along. We are an independent group of financial advisors. Next, I'll be entering some links in the chat. They're going to pop up right above our heads as we're speaking. Those links are going to guide you directly to our website where you can book an appointment with one of our ExxonMobil focused advisors. You can take advantage of many blogs we have focused at ExxonMobil employees that will keep you updated, and many other resources that we think you would find of use if you took advantage of them. You can also follow us on YouTube. You can follow us on LinkedIn. We have a page there as well. Take advantage of those. We post tons and tons of content for ExxonMobil employees and retirees, and we really feel you get value out of it if you considered giving us a follow. And without further ado, we're going to jump into the presentation with Wesley Boudreau to speak to you about NUA strategies.
All right, thank you very much for the introduction, Samantha. And like she said, my name is Wesley Boudreau. I am one of the ExxonMobil focused advisors here at the Retirement Group, now part of Wealth Enhancement Group. And like she said, we're going to be talking about NUA, and which is net unrealized appreciation, and what it means for ExxonMobil employees we work with. How do you kind of recognize it? What are those next steps? How can we help you out with analyzing it and things of that nature? Before I get started, a quick reminder, even though we have worked extensively, myself included, with ExxonMobil employees for a long time, does not mean we're endorsed or employed by ExxonMobil, but I've gone through so many of these scenarios. I've helped individuals out of mistakes that Voya and ComputerShare have made, and so I've probably seen anything you're looking at, so we can definitely help you out, let you navigate and avoid some of the potential pitfalls you could see ahead. Now, as far as NUA, what is net unrealized appreciation? Very simply put, it's a favorable tax treatment that not everybody's got, but ExxonMobil employees tend to have it because it only affects you if you've got low cost basis stock, low cost basis company stock. With ExxonMobil, a lot of you do have that unless you've traded it back and forth and traded away some of that NUA. The other beauty of it is ExxonMobil, unlike a lot of other companies, will actually give you line by line your cost basis. I'll show you a slide a little bit later in the webinar, but generally speaking, most companies will do what's called an average cost basis. ExxonMobil does not, so it's beneficial. But if you don't know what NUA is, you just roll over your account to an IRA or keep it in the 401k and take withdrawals. Typically speaking, you're going to be hit with ordinary income taxes on that because most of it's going to be pre-tax money. You may have some after-tax or Roth in there that would be tax-free as well, but most of it's going to be pre-tax. So NUA is the ability to actually pay taxes now whenever you exercise it on the low cost basis portion of your stock. And the growth, in the future growth, you would actually pay long-term capital gains instead of ordinary income. And right now and historically, long-term capital gains have always been cheaper or lower than ordinary income tax brackets. So the potential savings could be 7% or higher on the amount that you're actually doing. And keep in mind, if you access it or you do it, you have to roll over the rest of the account to an IRA in order to do it. It's an all or nothing situation, not a piecemeal option. And there's some different eligibility requirements we'll talk about in just a moment, and other issues to be aware of as far as if you take withdrawal, how do you actually access that, and what are those different limitations. So eligibility. Really there's just kind of 3 or 4 different eligibility criteria, or what they call triggered events. You can look at separation of service if you're leaving ExxonMobil. Once you turn 59 and a half, you have to have left as well. And then death and disability. So let's hopefully scratch those last 2. We're not going to get into that, but typically what we're going to see is if you're separating service and or you've turned 59 and a half. Now you could potentially have 2 triggered events, meaning somebody who might have left before 59 and a half had the ability to exercise NUA because they had that separation trigger, and then later on they could actually have another trigger of 59 and a half. Now somebody, let's say, retired at 60 or 65, they're hitting both those triggering events. They're separating service and they're already over 59 and a half. So again, you only have 1 triggering event in that case. So again, it's important to understand these because it could mean whether or not you actually qualify for NUA or make mistakes and miss it in some cases. So as far as NUA and the process when you actually do that transition, like I said before, it's an all or nothing situation. Whenever you actually say, hey, I want to exercise NUA at the end of the year and close it out by either withdrawing or rolling it over to an IRA. Now, obviously, we're going to tell you to roll it to an IRA. You don't want to take a big withdrawal and a tax hit on that. So again, Once you do that NUA, you have to exercise the rest of it and roll it over to an IRA by the end of the year. On the flip side, if you've taken a withdrawal, it's your first withdrawal after you've separated or after you're 59 and a half, you have until the end of the year to actually exercise NUA, or else you're going to forego that. So, one of the worst case scenarios would be, let's say somebody didn't know what this is, they've got some good NUA potential, but they never looked at it, never called us up. And maybe it's something as simple as, hey, December 1st rolls around and you need a little bit extra money for Christmas. You call up Voya, say, hey, can I get an extra $1,000 or $1,500 out? And maybe that rep didn't tell you about NUA. You take that small withdrawal, and then you got 1 month left. Once January rolls around, you've blown up the NUA capabilities on there, meaning you cannot exercise NUA anymore. I can't tell you how many times, unfortunately, we sat down with somebody for the first time, and they've already retired or something like that, and we have to tell them, hey, we could have done this for you, but you missed that opportunity. So again, it's good to talk with us ahead of time. Even if you decide you're not going to work with us, we can at least make sure you avoid some potential mistakes you have coming to you there. And when you do that transition, it all has to go through Computer Share, which is the transfer agent for ExxonMobil and Voya. So what would happen is you exercise that NUA. It goes over to Computer Share. It takes about only takes a little bit of time for it to go over there, but it takes about a month for them to get you a statement. And from there, you can transfer it over to your account. If you're working with us, we clear through both Charles Schwab and Fidelity. So typically the process is we exercise NUA, that goes to Computer Share, and then within about a month or so, we transfer that over to Schwab or Fidelity. Now let's go through kind of a quick example here that I put together, just give you kind of a hypothetical ExxonMobil employee. This is similar to what we see a lot of times. If you look at the bottom of the screen, let's assume you've got somebody who's retiring, got about $1 million in their 401k. They've saved both pre-tax and after-tax, so they've got pre-tax balance about $900,000. They put in about $100,000 of after-tax. Now that may have grown to 150 or 200 or 300. All that growth is considered pre-tax in this case because it's tax deferred. You have to pay taxes on it. And they may have some NUA in here. This may be, they may only have about $200,000 worth of ExxonMobil. They may have the entire $1 million worth of it, and they just chose to exercise NUA on only $200,000. In this case, they've got a cost basis of $50,000. And then they've got they're going to on that $200,000, and what would happen is that $200,000 they would pay tax on the ordinary income on the $50,000. On the growth, they would pay long-term capital gains when they sell it eventually. But first, it would roll over to a brokerage account again through Computer Shares, and then onto the brokerage account that you want to hold it at if you don't want to keep it there at Computer Shares. The pre-tax portion that would roll over to an IRA, and then the after-tax basis. At a minimum, Voya is going to make you pay the 20% out of that. So if you've got that $50,000 cost basis is all pre-tax, you'd be looking at a $10,000 withholding on there, which is 20%. So $10,000 of that after-tax would come out of there, leave you about $90,000 that can roll over to a Roth IRA, or you can just have it cut as a check to you. It's tax-free. Obviously, we'd recommend you roll that to a Roth IRA so that continues to grow tax-free moving forward. Now, as far as that example, let's kind of extrapolate a little bit and focus just on the NUA portion. Let's take a look at Lucy Norton in this case. Let's assume, again, she had $200,000 worth of Exxon stock she wanted to exercise NUA on. About $50,000 is the cost basis of there. So, again, she would be paying taxes on that $50,000 now or the year she does this. And the growth at $150,000 will not be taxed until she sells it in the future. And that'll be long-term capital gains, which would be 0, 15%, or 20% depending upon her tax bracket. In her case, let's say she doesn't want to sell it immediately. She wants to go ahead and hold on to that for a while, maybe 10 years in this case, and let's assume it doubles from that $200,000 value to $400,000. So let's take a look at what would happen to her in this case. So on the right-hand side, if she didn't exercise NUA and she just let this stay in the 401k, or she rolled it to an IRA and decided to take withdrawal later on, depending upon when she takes those withdrawals and how much, she's going to be either in the 10, 12, 22, 24, or 32% tax bracket. And again, those are graduated. So if she said, hey, I want to blow out all of this at once and it's now worth $400,000, that would put her right there in that 24% tax bracket. Some of it would be 10, some 12, some 22, some 24. So her average may be 19% or 20% or something like that. But again, for an example we're going to show on the next slide, we're going to assume in a vacuum she is doing that. She's just going to take the entire amount out all at once. Now, again, that's likely not the case. We look at NUA valuations on an annual basis and kind of break down that tax strategy for you. But in order to give you kind of an apples-to-apples comparison, we're going to assume a vacuum in this case. On that left-hand side, if you were doing the NUA, again, it's income tax on just that cost basis, long-term capital gains on the growth. Now, in this case, the That long-term capital gains on that 150, that's going to be embedded forever. You're going to have to pay that, but under certain, under current tax codes, if she didn't sell that later on and she let that grow and just pass on to beneficiaries, that additional growth would actually just step up in cost basis and be tax-free. Again, that's based upon current tax codes. So again, things can change. So be wary of that as well. So in this example, like we said, let's assume in a vacuum. Again, this is not real world, but in a vacuum, that she is deciding, hey, I want to blow out all of this in 10 years, take it, buy a house, whatever it may be. So in this case, on that left-hand side, or the middle side, I guess you would say, let's look at what would happen with NUA. And again, we're going to assume that there's no other income in this case. So again, probably not the case. We probably have other income to kind of build into the plan there. But in this case, let's assume she has no income. She's married. She's looking at exercising NUA, so that $50,000 she's going to have to pay income taxes on. The first $30,000 is tax-free because the standard deduction is $30,000. So she's only paying taxes on 20 grand. At that level, she'll only be in the 10% tax bracket, so it's costing her $2,000 up front. We let that grow. That $350,000 long-term capital gains she's going to be paying later on. She's not paying on the full $350,000 because what's going to happen is that standard deduction again eats away $30,000, so now it's $320,000. And then depending upon your tax brackets, the first about roughly $96,000 or so is going to be tax-free in this case. So 0% long-term capital gains. Excuse me, and then she'll be paying the 15% capital gains on the residual there. So she's paying about $33,000. So total about $35,000 and change in taxes for this situation. Now, on the other hand, if she were looking at, just taking this out on a taxable basis, she would be paying taxes across the board for that and end up being the 24% tax bracket and paying about 75 grand or so in taxes. So the net savings is about $39,000, $40,000 or so roughly on this. Now, again, like I said, it's in a vacuum, but let's take a look at, I took the time to kind of run a scenario to show you different options, whether she was looking to exercise this immediately for tax savings, let it grow for 10 years at 7%, or let it grow for 20 years at 7%. This is more in line with what I do and what we do on a daily basis when we run these Roth these NUA these NUA reviews to kind of show you what that option is. And it's not going to look as lucrative as what the other one was, but let's say she's just going to exercise immediately, and we'll take a look down there at the very bottom. We've got different options whether you want to pay pay the taxes with the stock or out of pocket. So on both of these, about $13,000 or so is the beneficial savings here. If you were looking at letting it grow for 10 years at 7%, that could be a little bit higher in that $20,000 range or so if you look at the very bottom of the screen. And if you let it grow for 20 years in this case, you could be looking at actually about $40,000 or something in that nature of potential savings. Now again, keep in mind this is assuming current tax brackets. Obviously in 10 or 20 years those brackets will likely be different from what they are now, but it gives you a good idea of what those potential savings are. Another thing I need to kind of warn you is, we work with a lot of people that we look at this and we say, hey, this is great. You could potentially save, $10,000, $20,000 in taxes or so. But we look at the portfolio and realize, well, yeah, that's great. Those are savings, but based upon how much ExxonMobil stock you have, just $1.50 or $2 swing in the price could actually wipe some of those out. So we got to also factor in what's your true goal. Are you looking to hold this stock for a long term? What is your thought process on the pricing of it and how that plays into it as well? Because when we transition this and it goes over to computer shares, you are going to be kind of MIA for a little bit, where you can't make any trades or do anything. So you are subject to whatever the market does in that time frame. So it's again another item to be aware of in this case. So let's take a look at ExxonMobil specifically. What I did is I kind of took a 401k a statement here, kind of compressed it into some of the different line items we're going to be looking at usually, and just change the numbers to make this kind of simple math on some of these. But let me kind of zoom in here. Or actually, I don't have to. I got the glasses on. So as far as in this example, let's assume this person got about $1.35 million in their 401k plan. We look at the breakdown. About $850,000 of it is before tax, about $50,000 is after tax, and about $450,000 is the general account, which is going to have the company match in there as well. But of that $50,000, they've actually put in about 20 grand over their career. So that post 86 is going to show you what you've actually put in. So your after tax cost basis, the portion that's going to be tax free and eligible to take out or roll over to a Roth IRA. So in this case, that 20 grand has grown to 50,000. So that extra 30 grand of growth, that's all going to be tax deferred, and you'll eventually pay taxes on it. So that's why it's beneficial once you retire to move that 30,000 over, or you can even potentially do it while you're working, not all of it, but a portion, move that over to a Roth IRA. So that way, the future growth on that's going to be tax-free instead of tax-deferred. So in this person, this case, if there was no NUA being exercised, they could roll that $1,330,000 over to an IRA, and that 20 grand over to a Roth IRA. Or if they just want to take that as a check to themselves, they can do that as well. I would argue the Roth IRA is going to make more sense. If you were adding NUA, you need to determine the cost basis level that you desire. And I'll show you in the next slide what I mean by that. Determine the cost basis level, because there's a lot of options you can look at there. Because again, one of the unique features about ExxonMobil, again, giving you the line-by-line cost basis, is you can pick your own cost basis essentially there versus the average cost basis, but it does get confusing a little bit. And then whenever you do that, again, keep in mind all that stock, NUA stock, and then also if you're looking at transferring the IRA stock in kind, goes to a computer share. So again, you got to make sure that you get us on the phone to kind of walk you through that and make sure you avoid some potential mistakes that could be there as well. So how do I decide? The good news is you don't necessarily have to decide. You can give me a call and we can kind of go through this one-on-one. But this big chart is really an example of what you may see at the bottom of your 401k statement. Usually what's going to happen is, unless you've traded it back and forth, you're going to see all your cost basis, and it's going to roll up over the time. And obviously the more recent ones are going to have a higher cost basis. But in this case, you might look at this and say, okay, well, what we're looking at is that left-hand column is going to be your cost basis, the price per share. Then the other column is going to be your before tax, after tax, and general account. And you can see where you've got some of the, it grows up, or you got some bulks. In this case, there's a bulk amount, that 42, price of 42 and below. And so again, it still kind of looks a little bit daunting on there. You got to total them up. It's just giving you column by column. And what we do, or what I do, is run a full spreadsheet for you to kind of go through there, help you highlight the different options, and run a break-even analysis, and kind of give you a play-by-play on what the taxes look like, and let you know what your potential savings are. We can also look at if the price of the stock fluctuates, what can wipe out those savings. We go through all of that when I provide an NUA analysis for you. So again, if you have any questions on this, just give us a call. We can definitely dig into this and help you out with it, and make sure you avoid some potential mistakes over there. To kind of wrap all this up and kind of bring it together, really the best way to kind of focus on this is going through excuse me, a financial plan. Right now, about 3/4 of Americans over 50 don't have a written plan. You can spend about 10 minutes with us. We can gather some data, especially get the 401k statement to run that NUA analysis for you and run a full financial plan. You may have other questions of, hey Wesley, I'm thinking about retiring at 62. Is that right? Should I work longer? Can I go earlier? How do I actually take the pension? Should I take the annuity? Should I take the lump sum? Should I do a combination? Another unique benefit that ExxonMobil has. We go through all these different options, and we can run various scenarios, and that helps us back into what are your goals, what are you trying to achieve, and then it can also help determine that NUA strategy we're looking at as well. So a quick reminder who the retirement group is. Again, we are an independent financial advisory firm, and again, we've been working about 30 years with Fortune 500 companies, about 15 with ExxonMobil. But last year we did merge with Wealth Enhancement Group, a much larger investment advisory firm. We did that in order to give you guys some more capabilities. We got about $100 billion under management, about 150 offices across America. There's more of a family office aspect now, where we've got in-house tax planning services, in-house estate planning services, a lot more advanced investment strategy options available to you. Just give me a call. We can kind of go through all those different options, especially for those of you that are highly compensated employees and have non-qualified pensions and things like that. There's more strategies that we can dig into for you as well. Again, offices across America. If you need to sit down face-to-face, we can accommodate that. But obviously, just if you want to give us a call, we can work via phone, web meetings, email, whatever your preferred communication is. And ultimately take us up on that cash flow analysis or financial plan. Those are free. They're complimentary, with the assumption that hopefully once we uncover things, you may want to work with us, or even if you don't, you let somebody else know at Exxon that about the service we provide, and it might pan out that way. So again, any questions, don't hesitate to give us a call. I'll leave this up and I'll get into some of the questions. Looks like we did get here. But there's a QR code if you want to schedule an appointment with myself or one of the other ExxonMobil focused advisors here at Wealth Enhancement Group and the Retirement Group. If you want to reach us directly, you can call us at 800-900-5867 or email us at info@theretirementgroup.com, and we'll be sure to follow up with you. And then a couple of questions, I saw two come through here. One of the questions is, if I took an age 55 withdrawal, can I still do my NUA? Okay, this is actually a pretty good question. It kind of goes back to when I was talking about the triggering events. So I remember I mentioned there's separation from service and there's age 59 and a half. So this individual must have retired at 55 or later. So I'm going to make up, maybe they retired at 56, took some withdrawals because they understand the age 55 rule. If you don't know what that is, that's if you, typically speaking, if you want to tap into your 401k or IRA before 59 and a half, there's going to be a 10% penalty. However, in a 401k, if you're doing it, if you separate service a year, you turn 55 or later, you can tap into it without that 10% penalty. So in the case of this, if somebody was working with us and we probably would not have them roll over everything to an IRA just yet. We would have them keep something in the 401k so they can tap into that without a 10% penalty. So in the case of this person, if they've taken those age 55 withdrawals and they're not 59 and a half yet, then yes, you could exercise NUA once you hit that next triggering event of 59 and a half. Now, if you started age 55 withdrawals at 57 and now you're 61, then no, you took a withdrawal after 59 and a half, then you've passed that and you can't do it. So it really depends upon where you are in that stage, but potentially you could. Just give us a call. One more here. Am I able to donate my NUA? So yeah, I didn't put this in there. I probably should have put a whole slide on that, but that's another tax planning aspect with NUA, in which case you may be able to donate it if you don't need that and you want to avoid paying the taxes and also potentially get a tax deduction on there. So in the case of Lucy, let's say that she did that, paid tax on that $50,000 and maybe wanted to immediately donate the stock. So that $150,000 she didn't have to pay taxes on. She got a potential deduction on that, or maybe she wanted to grow later and do that later. And it's going to depend upon her situation. In the example we gave her, she was taking standard deductions, but if she was itemizing, she could potentially take advantage of that appreciated stock up to 30% of her AGI in order to deduct that from her taxes. So that's something we definitely do review. We would typically look at doing that and moving it over to what's called a donor advised fund, so you can have future distributions going to charity versus having to do it all at once at a single charity. So we do that. We do that quite a bit. So if you have any questions on there, just give us a call. And that does remind me another. Excuse me, out of focus. Another item that might be beneficial to some of you is again, we talked about once you take a withdrawal, you have to exercise NUA. I'm gonna work with somebody right now that is approaching RMD age, is not taking withdrawals because they haven't needed it. So if they are wanting to exercise NUA, once we do that first RMD, they have until the end of the year to do that. Now, if it's your first RMD, you have the ability to actually defer that to the next year. You have to double dip though, but it could be beneficial to look at that on the tax situation as well. So again, just keep that in mind if you've been holding on to that 401k for quite a while. I know a lot of clients, we do suggest keeping the 401k because it's got very low cost within there. But since the last couple of years, costs have come down on ETFs, we can actually match that. And we'd obviously argue that active management is going to be better because you've only got 6 or 7 choices within the 401k. But again, if you like it and you want to keep it, that is something to review. But it's good to know about NUA as well. So with that, don't hesitate to give us a call at 800-900-5867. We'll be happy to go through all this with you. Again, like I said, I've worked extensively and I can kind of walk you through some of the potential mistakes to avoid. But again, even though we've done that day in and day out, does not mean we're endorsed or employed by ExxonMobil. But don't hesitate to give me a call. We'll be happy to run through your personal situation. Thank you, and we hope you have a great day.